It's 3:47 in the morning. You're awake. Again. Staring at your phone in the dark, watching futures tick lower. The urge to sell everything is almost physical. The S&P 500 is down 6% from its high. Headlines are screaming about tariffs, oil shocks, and recession. Your portfolio just lost what feels like a small car. Every instinct says, get out. Protect what's left. And honestly, that instinct is going to cost you a fortune. Let me show you exactly how much. $1.48 million. That's the number. That's what $100 invested in the S&P 500 in 1926 would be worth today. But here's the thing. That money sat through 26 bear markets, the Great Depression, World Wars, oil crises, every recession your grandparents can name. It never moved. And the people who panicked? Who sold at the bottoms? They missed an average 150% gain from the recovery that followed. Every single time. Right now, recession odds are sitting between 40 and 50% according to major forecasters. Prediction markets put bear market probability around the same number. Your neighbor sold last week. Your coworker is all cash. Twitter, X, is full of people who've never been wrong about anything, telling you the crash is coming. And here's what nobody's telling you. That fear you're feeling? It's not irrational. Markets do crash. People do lose money. The question is, which people? Let's look at 150 years of data, not opinions, not predictions, just what actually happened when markets fell apart and what happened next. U.S. stocks have endured 26 bear markets in the past 150 years. A bear market, by definition, means stocks dropped at least 20%, 26 times. And the market recovered from every single one of them. 100% recovery rate, not 95%, not most of the time, every single one. The Great Depression, the worst crash in American history, saw stocks fall nearly 90%. It took until 1954 to fully recover. But it did recover. Here's a number that changes how you think about all this. The average bear market lasts about 14 months. The average bull market that follows, 4 years. Think about that ratio. 14 months of pain, 48 months of gain. If you sell during the 14 months, you miss the 48. And here's where the math gets brutal. An investor who sold at a market trough over the past century would have missed on average 150% gain from the following bull market. Not 50%, not even 100, 150%. That's the average cost of panic. The price of hitting that sell button at the worst possible moment. Let me make this real. $100 in the S&P 500 in January 1926 with dividends reinvested would be worth approximately $1.48 million today. That's a 10.3% compounded annual growth rate over 98 years. Through every war, every recession, every crisis that made headlines say this time is different. Now, I need to be clear here. Past performance doesn't guarantee future results. That's not just legal language. It's true. Markets could behave differently going forward. But 150 years of data across 26 bear markets is about as close to a pattern as financial history gets, and the pattern is clear. Here's what fascinates me about investor behavior. The average equity fund investor earned 10% annualized over the past 30 years. The S&P 500 itself returned 10.92%. Almost 1% annual difference. That gap, nearly a full percent every year for 30 years, comes almost entirely from poor market timing, buying high, selling low. 1% a year doesn't sound like much, but over 30 years? That's the difference between retiring comfortably and having to keep working. The math is devastating. The irony is brutal. The moments that feel most dangerous, when every headline screams, sell, those are historically the moments when selling costs you the most. And the moments that feel safest, when markets have been climbing for years and everyone's bullish, that's often when the real risk is building. Let's talk about what's happening right now. As of late March, the S&P 500 was down about 6% from its all-time high. That's not a bear market. It's not even a correction. A correction is 10%. A bear market is 20%. 6%? Historically, that's noise. It happens regularly in healthy, growing markets. But it doesn't feel like noise when it's your money. When you watch $20,000 disappear from your retirement account in a week, percentages feel academic. And that's exactly why this data matters. Your emotions are lying to you. They evolved to keep you alive on the savannah, not to make good investment decisions. Kalshi prediction contracts, where real money is on the line, put the odds of an S&P 500 correction at 58% this year. Bear market probability sits around 50%. 50-50? A coin flip. And here's the thing. Even if the bear market comes, the data tells us what happens next. It always has. Bear markets rarely last longer than 2 years, and waiting too long to get back in risks missing the sharp rebound at the start of the next bull market. That rebound is often violent. The best days in the market tend to cluster right around the worst days. Miss the recovery and you've locked in your losses permanently. Let me tell you about Elena. She's not a real person, she's a composite of investors I've studied. But her story is real. It's 6:30 a.m. She's staring at her brokerage app. Markets dropped overnight. Her retirement account just lost $9,000 while she slept. She's 61. Her finger hovers over sell all. She's been doing this for 40 years. Building. Saving. And now this. Her mind is screaming, protect what's left. This is the moment that separates investors who build wealth from investors who destroy it, and the data on that split, it's brutal. Investors who sold during the 3 previous triple hold periods by the Fed and sat in cash for 6 months missed an average rebound of over 14%. Investors who held through it, they were whole again within 9 months on average. Same storm, completely different outcome. The smart move isn't to act on one data point. It's to know which data points deserve your attention and which ones are just noise designed to make you feel something. So what do you actually do with all this? Let me give you a framework, and I want to be clear, this isn't financial advice. Your situation is specific to you. Consider writing down your investment thesis and time horizon before market hours. Decisions made during volatility are usually poor decisions. That's not opinion. That's what the behavioral research consistently shows. If you're 10 or more years from needing the money, current market declines may be mathematically irrelevant to your final wealth. That's worth sitting with. Many behavioral finance experts suggest avoiding checking your portfolio daily during volatile periods. Increased monitoring correlates with increased panic selling. Your phone is not your friend right now. What approach some advisors recommend? Systematic rebalancing instead of emotional selling. If stocks fall below your target allocation, that's potentially a buy signal, not a sell signal. If you must reduce risk, consider doing it gradually and systematically, not in response to a single bad week. Plans made in calm carry you through chaos. Now I want to be careful here because this is where people get burned. A pattern is not a prediction. The 100% recovery rate is historical. The future doesn't come with guarantees. Here's the honest version. Nobody, not the Fed, not Wall Street, not your favorite finance podcast, knows what markets will do in 6 months. What we can do is look at what the data has shown historically, with the full understanding that history rhymes more than it repeats. The debate right now centers on whether this time is different. Bears point to unprecedented tariffs, geopolitical conflict, and high valuations. The S&P 500 CAP ratio sits around 40. Bulls counter that the same arguments appeared before every single recovery in 150 years, and the 100% recovery rate reflects the fundamental resilience of diversified economies. Neither side denies that selling at bottoms destroys wealth. That's the one thing everyone agrees on, whether they're bullish or bearish, short-term or long-term. Let me bring this back to Elena. She's still sitting there, phone in hand, $9,000 gone overnight. What does she do? If she sells now and the market recovers like it has every single time in 150 years, she's locked in that loss. She's out. She has to decide when to get back in. And here's what behavioral finance tells us. she'll probably wait until it feels safe to return, which means she'll miss the sharpest part of the rebound. Instead, Elena puts down the phone. She goes for a walk. She remembers why she built this portfolio in the first place, for a retirement that's still 4 years away. The 9,000 will probably come back. It always has. And if it doesn't, she has 4 years to figure it out. 4 years is a long time. Your job isn't to bet on the pattern. It's to prepare for both outcomes. To have a plan that works if markets recover quickly, and one that works if they don't. The data suggests that time in the market tends to beat timing the market, but you have to verify that for yourself, with your own advisor looking at your own situation. Here's what I can tell you with confidence. The urge you're feeling right now, that desperate need to do something, has destroyed more wealth than any bear market ever has. The sell button is always there. It'll be there tomorrow. It'll be there next week. You don't have to touch it today. $1.48 million from $100, 98 years, 26 bear markets, and one simple rule: don't panic. That's what 150 years of data keeps telling us. The market rewards patience. It punishes fear, and the math is unforgiving. If this kind of analysis helps you stay calm during volatile markets, consider subscribing. We break down the data like this every week. No hype, just signal. Remember, this content is for educational and informational purposes only and does not constitute financial advice. Always consult with a qualified financial advisor before making investment decisions. The market's been around for 150 years. It'll be around tomorrow. The question is, will you? Don't touch that sell button. I'm serious. Put the phone down. Go for a walk. And I'll see you next time. Remember, this content is for informational purposes only and is not financial advice.